Hello and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, Vladimir Putin and Xi Jinping vow to cooperate against destructive and hostile US, as well as that high debt levels put Europe at risk of adverse shocks. The ECB does warn. We've got lots to talk about in the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it, though, make sure you subscribe. The first article to talk about is to do with Putin and Xi Jinping. Now, Putin and Xi Jinping have now vowed to stand together in what they call destructive and hostile US pressure, with both powers agreeing to deepen ties. This came following Xi welcoming Putin to Beijing ahead of meetings which are aimed at building on their close relationship and building stronger economic ties to help Russia. Now, obviously, this article is following up on what we were talking about yesterday when we were talking about basically this meeting that was going to take place. We spoke about how this is the first kind of foreign trip, kind of diplomatic trip for Putin since, of course, he was sworn in for his fifth presidential term last week. And at the moment, of course, Russia's in a very interesting time. Not only is Russia currently invading Ukraine, but of course there's a lot of kind of political heat within Russia against Putin, and with their kind of political enemies and that kind of thing within the nation itself. And we know that there's been a great deal of turmoil over recent years, especially since Russia's invasion into Ukraine. And China's kind of also in this interesting position where, of course, their worst kind of their relations, with the US is kind of at an all-time low, just like it is with Russia and the US. And also at the same time, we're seeing the US, lay on new tariffs, new kind of sanctions against Russia, but new tariffs against China, of course, with the most recent article that we spoke about on this channel, also being around the US Biden administration implementing new tariffs on Chinese EV exports, as well as Chinese chip making industries and that kind of thing. So most certainly relations are kind of already at this all-time low between the US and both China and Russia, but quite interestingly, of course, the US and China have kind of just tried to amend relations recently. This has kind of been a key point that we've noted on this channel, is both Biden and Xi over the past year or so have really started to work together to try and enable proper communication between the two powers, which are, of course, the two most powerful nations of the world. And so we've not only seen the US host Xi Jinping and other Chinese officials in San Francisco, I believe that was last year, but then we've also seen Xi Jinping carry out the same kind of host in China this year as well, with US CEOs also traveling there, as ultimately, as international relations between the two nations have worsened, so has business relations. And so that's kind of been a key point which both leaders have tried to address. More importantly, to the kind of topic of military stuff, though, of course, the US and Chinese military officials for the first time recently have started to kind of interact and communicate with one another, as of course this came to an end, or at least this stopped, following Nancy Pelosi's visit to Taiwan back in 2022, which kind of did drop relations to rock bottom, as of course Taiwan is seen as kind of a part of China by Xi Jinping. However, of course, many nations unofficially, such as the US and most Western nations, of course, consider Taiwan as an independent entity and that kind of thing. And so as a result of that, whenever a kind of US or Western official is to visit Taiwan or kind of somehow embrace the kind of political independence of Taiwan, China becomes quite infuriated and then acts in very hostile ways to those powers. And that's why we did see, of course, a great deal of Chinese flyovers and airspace incursions during that time where Nancy Pelosi did, of course, visit Taiwan. And following that, of course, we've seen the Chinese spy balloon hover over fly over the US after that being shot down. Relations were worsened, of course. So most certainly hostilities are already kind of at this all-time high between the US and these two nations. However, as I've just mentioned, there's been some effort to kind of amend those worsened relations. However, this article, this topic, this piece of news really does kind of stamp out any of that optimism and really, takes us back to that key understanding that it is kind of China and Russia against the West. You probably also have to lump in both Iran and North Korea to China and Russia, but really the two most powerful nations within that anti-US alliance seem to be Russia and China, which, as we can see here, are now vowing to cooperate with one another even more, which of course is sounding very worrying to the US and the West, which over recent months have been trying to work to kind of decrease hostilities and also get Xi to move away from supporting Russia's invasion into Ukraine. With this foreign trip by Putin being his first since he was sworn in for his 5th presidential term just last week, and this agreement for the two powers to now work together against the West stamps out any optimism to do with Antony Blinken, who urged to China to stop support for Russia's invasion into Ukraine. This, however, also now begs the question of whether the US may be open to sanctioning Chinese financial institutions if Beijing is to continue Russian support, with this idea of new sanctions on Chinese financial institutions obviously following on from the more recent tariffs imposed by Biden on chipmaking and the EV industry in China. So an increasing number of tariffs, sanctions, and that kind of thing on China is only kind of going to worsen these relations and increase hostility. So, we have to also factor that in when we're thinking about how things may play out, as we see kind of the kind of distance between the West and China and Russia kind of deepening. So definitely think about that. Worryingly, both powers also pledged to strengthen their military ties whilst expanding on their combined exercises. Talks between Xi and Putin's new defense secretary and secretary council chief is also expected to take place. That's all about in this article, though, a very important one with regards to world tensions, as of course world tensions affect markets greatly, to do with assets such as gold and others, which are highly dependent on the state of world affairs and whether there's any wars going on and that kind of thing. So a very important article covered there and lots to think about, most certainly. Next to talk about, though, is to do with Europe and European debt. Now, the ECB has now warned the public and investors that European countries are highly vulnerable to adverse shocks from geopolitical tensions and higher interest rates. This being due to the fact that most European nations have failed to keep their debt down. Now, this is kind of something that we've already sort of heard from the ECB, really. If we think back to, what the head of the ECB has been saying recently or over the past few months, ultimately the key warnings to do with inflation and that kind of thing have been around the idea of any geopolitical shocks. We know, of course, the Middle East and the wars taking place there at the moment putting the kind of risk of inflation, making a great risk to inflation, of course, as oil is a large part of inflation, that with that playing into fuel prices, energy prices, and that kind of thing. And so any shocks, war, geopolitical skirmishes and that kind of thing greatly affects oil's price, and therefore, should oil spike to the upside as a result of a regional war breaking out in the Middle East, ultimately then we may see inflation spike in Europe, for example. And that's kind of been the key warning laid out by the European leaders and the ECB, and so this is kind of something that we've heard quite a few times. What we haven't really heard as much about, though, is to do with the high debt levels, which is creating the adverse, or is creating the vulnerability to adverse shocks, with this idea of having high public debt ultimately playing into the idea of European nations being at risk to these adverse shocks, these outside shocks. And this is kind of obvious when we kind of then factor in the very high debt to GDP ratios that we're seeing in Europe at the moment, just following on from both COVID and then Russia's invasion into Ukraine, with these both creating a great deal of kind of fiscal spending and that kind of thing. So that's greatly weighed on Europe, it does seem, and the ECB is now warning of the potential impacts this may have on economies of Europe should anything break out within the Middle East to do with a regional war, or even anything to do with, another financial shock like we saw with the financial crisis back in 2008. So, this is definitely something that we have to think about when we're looking at the euro and other, European assets, when we are hearing from the ECB these key warnings to do with adverse shocks. So definitely lots to think about there. Next, but ultimately, the ECB's twice yearly financial stability review highlighted the fact that most European governments have still not reversed support measures from the COVID-19 era, with a key warning being that high debt levels and lenient fiscal policies can spook investors and therefore force the ECB to raise rates further, hurting everyone as a result. A more positive note was the risks to the financial system recently have receded due to household and corporate debt declining. However, sovereign debt is likely to stay high. The ECB has also noted that there are structural challenges which remain a drag on productivity and growth within the Eurozone. However, economic activity is expected to pick up over the next couple of months thanks to resilient labour markets, lower inflation and expected rate cuts by the ECB. So it's a very interesting time for the Eurozone's economy, pardon me, and it'll be very interesting to see how lower interest rates and interest rate cuts over the next year will affect markets and that kind of thing. So lots to think about there. Let's also talk about in the articles though. Next talk about, of course, is the charts, where like always we are beginning on the US 30, but we won't dilly-dally, and ultimately we're covering the US 30 but also covering other US indices as well, just kind of doing that general overview. And if you can see on the right hand side, you can obviously notice the fact that this is a negative day, or this has been a negative day for markets yesterday, with on the US 30, price not moving much, but ultimately somewhat hooking back on that previous price action that we've seen form over recent days. As of course, since Tuesday, we've seen price push to the upside. So Tuesday, Wednesday, and then Thursday, price was able to push to these new all-time highs, finally breaking above these most recent highs and all-time highs, with price just quickly peaking above those levels. And now it does seem like price is hooking back on itself and coming back down a bit. Now, an interesting thing to note though is of course that this entire retracement, this largely retracement with price coming back to near all-time or near previous all-time highs, which lines up with this black line. This was a significant retracement, but as price has kind of reclaimed all of that retracement very, very fast when we think about it. I mean, this was a very significant move, with this retracement taking out all that progress that markets have made since really December, January. So this move to the downside was very, very significant. And so to see price now respond and quickly come back to the upside is kind of a surprise to many, considering that ultimately the Fed's situation at the moment is still one in which we're likely going to see not as many rate cuts that we previously expected, and at most we're expecting 2 rate cuts this year, with those being expected to start as late as kind of September. So it is quite surprising that we still have so much bullish momentum within markets, but this could arguably just be explained by the fact that the US economy has been so resilient over recent months and years during the periods of COVID and then inflation, and we know that employment numbers and that kind of thing are still very strong despite all these issues. So definitely it's a very interesting time for the US 30 and other US indices, but on the shorter time frames, of course, as we do need to kind of talk about what's happening day by day, price has hooked back somewhat. It's not a significant move, but price has somewhat hooked back on itself to interact with this liquidity zone once again. So it will be interesting to see whether price will now continue from this level, or will price, kind of hook back just a bit more to maybe interact with these lower levels of liquidity before price can then continue on to the upside. So lots to think about there, lots to think about, and take that with you for the last day of this week on the US 30. That's all to talk about on the US 30 though. Next talk about is to do with the dollar, where once again there's not too much to say, but I have drawn out this Fibonacci retracement tool to kind of note what's happened today and note the opportunities which maybe are presenting themselves. Now ultimately price did swing to the downside on the dollar following the Fed's following the recent US inflation figure being released on Wednesday, which did show, of course, that basically rates, it didn't show anything to do with rates. It showed that basically inflation was moving to the downside. This was still in line with economists' expectations, but ultimately this did break the streak of inflation coming in above what economists were expecting. So this did kind of present a more dovish picture, which is why we did see this sell-off on the dollar, with the dollar breaking below this key area of liquidity as markets began to price in 2 interest rate cuts this year rather than just 1. So that was a very dovish figure for the markets, despite it coming in line with the economists' expectations, which is why we saw that sell-off. Ultimately though, yesterday it does seem like price has retraced following that kind of significant move to the downside. This could largely be explained by the fact that ultimately whilst the figure was dovish, whilst the figure did show that inflation was declining, ultimately it came in line with economists' expectations. So perhaps this is the markets pricing in the fact that this was not as significant a piece of data as previously expected, or in fact this could just be the markets finding liquidity before a continued move to the downside. So definitely think about that when we're also looking at the kind of key Fibonacci zones which the dollar's interacting with, such as the 38.20 at the moment. Next to talk about though is Euro USD, which has now broken above this key liquidity zone, as we noted yet in yesterday's morning market briefing. But as we saw on the US 30, just like we saw on the US 30, and kind of, looking at the inverse mirror of the dollar, we are of course seeing price hook back on itself and interact with this liquidity zone, which has previously acted as a strong area of resistance, but is now seemingly acting as a strong area of support. So it will be interesting to see whether the price will now swing to the upside from that liquidity zone. Next, talk about those pound yen, which is now which did sell off from this key liquidity zone that we noted in yesterday's morning market briefing, but ultimately in yesterday's market action, price was able to then find the bullish momentum to move back to the upside, and is now interacting with this higher area of liquidity and resistance. So it will be interesting to see whether price will now sell off from this area and make a double top, or will price now break above that zone, break above this key area of liquidity, and push to new highs. As of course, whilst this does not line up with any key Fibonacci retracement level or anything like that, ultimately price has retraced nonetheless, and definitely could be in a position to now break above. Next, talk about those Bitcoin, which is still at that kind of $65,000 Bitcoin territory, but ultimately has reacted to this key area of resistance and liquidity zone that we noted as the next area for price to interact with or possibly sell off from, and that is kind of what we're seeing. We haven't seen a large sell-off though, just a small retracement like we've seen in other markets. Next, talk about though is gold, which is in a really interesting position, as of course, this kind of swing to the upside that we've seen recently obviously came after price interacted with this 6180 Fibonacci retracement level, and now price has kind of released that kind of bullish momentum, released that bullish volume at this key Fibonacci extension level of minus 2720, which lined up with this key liquidity zone as well, and that's why we're now seeing this somewhat sell-off. So it will be interesting to see whether the price will now retrace a bit before then trying to break above those higher levels and push to new highs. So that's the key thing to note on gold. Lastly to talk about though is oil, where there isn't much to say apart from the fact that price is consolidating and stagnating, as we've seen since really the start of May. So not much is happening on oil for the moment. Price is still around that $83 a barrel level. That's all to talk about on the charts, though. Lastly to talk about, of course, is the economic calendar. To be honest, we're not receiving much economic data today, except there is one very important figure that you must listen out for. Now, firstly, we are receiving the Chinese industrial production, retail sales, and unemployment rate figure. Followed by that, we're receiving the French unemployment rate figure, as well as the Swiss industrial production figure. Followed by that, and most importantly of the entire day, we are receiving the Eurozone's inflation rate figure. So that will be very important to listen out for. That will, affect, of course, any European assets, affect also, gold, and most importantly will affect Euro USD or any Euro pairs. So make sure you're listening out for that inflation figure from the Eurozone. And finally, we will be having one Fed official speech as well as one Bank of England official's speech. That's all to talk about on the economic calendar, though. We've covered lots in the articles, lots in the charts, and lots in the economic calendar. That's all from us at Wildwood Capital. Have a great trading day. See you later. Bye.